There are two different types of sources of finance: internal, that is finance from inside the business, and external, that is finance from outside the business. New businesses starting up need money to invest in long-term assets such as buildings and equipment. They also need cash to purchase materials, pay wages, and to pay the bills. In the case of internal, existing capital can be made to stretch further. The business may be able to negotiate to pay its bill later or work at getting cash in early from customers. Over 60% of the business investment comes from the reinvested profit. If a business needs to generate more finance and can't internally, they may seek for external sources of finance. There are two types: loan capital and share capital. Loan capital. The most common way is through borrowing from a bank. This can be in a form of an overdraft or a loan, and is usually set over a period of time. It could be a short, 2 or 3 years, medium, 3 or 5 years, or a long term, that is 5 years plus. There will be an interest rate on the loan.
Some sources of finance are short term and must be paid back within a year. Other sources of finance are long term and can be paid over many years. Internal sources. There are five internal sources of finance: or owner's investment, retail profits, sale of stock, sale of fixed assets, debt collect. Owner's investment. Advantages: doesn't have to be repaid. No interest is payable. Disadvantages: there is a limit to the amount an owner can invest. Retained profits. Advantages: doesn't have to be repaid. No interest is payable. Disadvantages: not available to new business. Business may not make enough profit to plow. Sale of stock. Advantages: quick way of raising finance. By selling off stock, it reduces the cost associated with holding them. Disadvantages: business will have to take a reduced price for the stock. Sale of fixed assets. Advantages: good way to raise finance from an asset that is no longer needed. Disadvantages: some businesses are unlikely to have surplus assets to sell. Can be slow method of raising finance. Debt collection. Advantages: no additional cost is getting this finance. It is part of the business's normal operations. Disadvantages: there is a risk that debts owned can go bad and not be repaired. External sources. There are 9 external sources of finance: bank loan or overdraft, additional partners, share issue leasing, hire purchase, motorized, trade credit, government grants. Advantages: said repayments are spread over a period of time, which is good budgeting. Disadvantages: can be expensive due to interest payment. Bank may require security on the loan. Partners. Advantages: doesn't have to be repaired, no interest is payable. Disadvantages: diluting control of the partnerships, profit will split more. Advantages: don't have to be repaired, no interest is payable. Disadvantages: profit will be paid out as dividends more to shareholders. Ownership of the company could change hands. Advantages: businesses can can have the use of up to date equipment immediately. Payments are spread over a period of time, which is good for budgeting. Disadvantages: can be expensive. The asset belongs to the finance company. High purchase. Advantages: businesses can have the use of up to date equipment immediately. Payments are spread over a period of time, which is good for budgeting. Once all repayments are made, the business will own the asset. The advantages: this is an expensive method compared to buying with cash. Advantages: business has the use of property. Payments are spread over a period of time, which is good for budgeting. Once all repayments are made, the business will own the asset. Disadvantages: there is an expensive method compared with buying with cash. If business does not keep with repayments, the property could be. Advantages: business can sell the goods first and pay for them later. Good cash flow, no interest charges, money is paid within agreed time. Disadvantages: discount given for cash payment will be lost. Businesses need to be careful, manage their cash flow to ensure they will have money available when the debt is due to be paid. Grants. Advantages: don't have to be repaired. Disadvantages: certain conditions may apply. Example: location. Not all businesses may be eligible for grant. Bank overdraft advantages. This is a good way to cover the period between money going out and coming into a business. If it is used to short term, it's usually cheaper than a bank loan. Disadvantages. Interest is repayable, the amount or down can be expensive if used a longer period of time. Use of capital and revenue expenditure. General operating expenses. Any expense which is related to general operation of business, that all expenses will be revenue expenditures and will be delivered profit and loss account. To short period. This type of expenses are related to short period, means benefit these expenses is less than 1 year. For maintaining the stability of fixed assets. The expenses of main feature is that the expenses is useful for maintaining the stability of or efficiency of a fixed assets. Recurring nature. One of the most important features of these expenses that these expenses are recurring nature. In other words, these expenses happen again and again in general business activities. For example, expenses for giving refreshment in revenue expenditure because almost daily this type of expenses is paid to company. Helpful for maintaining the profit of business. This type of expenditure is useful for maintaining the profit of business, but also above features should include in the expenses which I have mentioned in above points, because capital expenditure will also helpful for maintaining the profit, and you will then confuse revenue and capital expenditure. Useful life. According to the IRS, capital expenditure on a property must have a useful life more than 1 year. Investments that only have temporary effect on a property. Fees paid to a professional consultant to assess the aptness or feasibility of capital expenditure are also considered a capital expenditure must add value to the asset. For instance, installing central air conditioning, a new driver, or a software filtration system add all to the value of a property. Exceptions. The IRS does not consider as capital expenditure any improvement that is no longer part of the home.
That influencing the different choices of sources of finance are basically chosen due to the context and the different factors that influence this decision. The most important factors are the purpose of use of funds. This is about whether a business will need to match the different sources of finance to the requirements needed, and it will depend on the use of purchasing a long-term fixed assets or for the short-term day-to-day running of the business. Cost is, in this case, when the business needs to consider the costs that are needed in order to obtain a source of finance. This means that the costs that include interest payments, administration costs, and also that imply the share issue. The status size is when the public limited companies can obtain finance from various sources. In result, the solo traders will not be capable of obtaining this. The amount that this will be required is when for example, the small amounts like the firms will consider the short-term sources of finance such as bank overdraft, but on the other hand, the long-term bank loans is an available option as well. In the flexibility, it depends on whether a business will need to switch or change from one source to another. The state of the external environment is when the factors that the business can't control, for example, the increase of the interest rates or in the inflation, are aspects that the business can't control. And to conclude, the gearing is when it depends on the share capital and the loan capital. This means that if a company has a larger proportion of loan capital to be shared, the gear will be higher, but if the company is low geared, it will have a lower proportion of loan capital to